Hey guys, welcome back to the Simple Health Coach, where we're all about health simplified. Here we are on lesson 4 of our Investing 101 for beginners. Simple investing strategies that make your money work for you. So far, we have learned Investing 101 about how the stock market works and the differences between stocks and mutual funds. We then learned how to access the stock market by opening an account with a stockbroker. In lesson 3, we are going to show you one extremely simple strategy that is going to make your money work for you. And then in lesson 4, we're going to talk about retirement accounts 101 from a 401k to an IRA. And finally, in lesson 5, we are going to show you the secret of what it takes to become a millionaire. So let's get started. By now, you're getting ready to invest, which means you have opened up an investment account with a stockbroker. You are now improved and you have withdrawn money from your bank account into your money market settlement account. And this is good news because it means that you're ready to start buying either stocks, mutual funds, or ETFs. So what's the difference between a stock, ETF, or mutual fund? Stocks are owning one company, or at least part of one company, whereas an ETF and a mutual fund are groups of companies. With stocks, we need to remember that they are higher risk, but they do offer higher reward. With owning a stock, as the business grows, so does the value of your stock, which is great news. However, if that company fails or underperforms, the value of your stock goes down and you end up losing money. Since in this course, we're focusing on low-risk strategies that are going to give you the best opportunity to make money, we're going to focus more on ETFs and mutual funds because they are lower risk and they still offer a moderate reward. Remember, both mutual funds and ETFs are lower risks because they are groups of stocks. So for example, if one of those companies goes out of business, you will see a temporary drop in the price as shown here. However, since all of the other companies in the groups are still alive and hopefully thriving, over time you will see that price rebound and making you more money over a long time period. So right now, we see that ETFs and mutual funds are really the same thing. The biggest differences are in that a mutual fund has slightly higher fees and a higher minimum to start. In comparison, an ETF has lower fees and a lower minimum to start. And since you're likely a beginning investor, this might be a great option for you to start without offering too much money in the beginning. So now it's time to learn a simple and easy investing strategy that's going to allow you to make money over time. But before we start, you must understand one crucial thing, and that is how the stock market is measured. So just as we measure our height with a tape measure or a ruler, the stock market is also measured with a tool, and that's called the S&P 500. The S&P 500 takes a look at the entire stock market. So there's a couple things I want you to notice about this graph. The first thing being is that there's lots of mountains and valleys. The biggest valley that you're going to notice is right here, and that was the Great Depression. Although there are mountains and valleys, I want you to notice the overall trend of this graph, and that it improves over time. So if someone has their money in the market for a long period of time, there is a good chance that it will make them money with that time period. So let's take a closer look. The S&P 500 has an average return rate of 10%, and this is dating back all the way to 1926. What this means is that on average, the stock market has grown 10% every year. So let's look at a simplified example. Say you decide to start investing this year, so it'd be year 1, and you start with a $100 investment. Now, we know that history has shown that you get a 10% return on your money, so that means that 10% of $100 is $10, and that brings your total to $110. Now, say year 2 comes around and you decide to reinvest that $110 into the market. Once again, you can assume that you will get that 10%, which would be $11 this time, bringing your total to $121. Same thing for year 3. You reinvest the $121. You make 10% on that, which would be $12.10, bringing you to a total of $133.10. It's important to realize that this money grew all from one simple investment, and you watched that money grow over time while you just sat back and relaxed and watched your money work for you. So here's the problem. The S&P 500 is a measuring tool, not a mutual fund nor an ETF. The solution is that you want to look for ETFs and mutual funds that actually mirror the entire stock market and the S&P 500. That's right, one that mirrors the stock market. This means that as the stock market goes up, then these ETFs and mutual funds will go up as well. Now, if the stock market goes down, so will the mutual fund and the ETF that you've selected. But remember that history has shown us that over time, the market will go up. Another way to think about the stock market is like pizza. Instead of deciding between which slice you're going to get, why not just buy the entire pie and then watch it grow and grow and grow over time, just like your money can. Over time, the money grows and allows you to get to the point where you can have true financial health and financial freedom. Now, if you want a free list of mutual funds and ETFs that mirror the stock market, then check out the link below and we'll send it right over your way. So let's look at an overview. If you have money transferred into your money market settlement fund, then you are ready to invest. Stocks offer a high reward, but they also have a high risk. In comparison, ETFs and mutual funds are groups of stocks that offer a moderate reward with low risk. ETFs generally have lower fees and lower minimums, therefore can be a good option for beginning investors. History has shown us that the entire US stock market grows 10% on average over time, which is shown through that measuring tool of the S&P 500. And then if you invest in ETFs and mutual funds that mirror the stock market, it is considered a low-risk strategy that grows your wealth over time. So what's next? In lesson 4, you're going to learn how to set up a retirement account, use it to invest, and save money on taxes while setting yourself up for a happy retirement. And it's important that you don't skip lesson 4, as it's an integral part leading to lesson 5, where you will take everything that you have learned so far and learn the final secret of what it takes to become a millionaire.